good day to you. My name is Mike Addison, and I'm representing Addsure, FSP 15269. In this short video, I'm going to explain claims ratio insofar as sectional title insurance goes, so that trustees, particularly portfolio managers, can better understand the concept so it's easier to understand and manage your policies. Claims ratio simply means for every 100 Rand of premium that the insurance company receives, or what you pay to the insurance company, how much of that 100 Rand was used for claims during a given period. Okay, so for example, in 1 year, if the insurance company received 100,000 Rand in premium, but they paid out 60,000 Rand in claims, then they have a 60% claims ratio to contend with. And of course, that can be over 1 year, it can be over the year to date, or it could be over a 3-year period, or it could be over the whole period since the policy incepted. What does that mean in sectional title? It's difficult to actually get any accuracy on a small complex, in all fairness, because you have 3 units, you'll be receiving a small premium, and 1 claim could take you over 100% for a year. So that's why for a small complex, a short period is not really that meaningful. And I always say in insurance, stats work very well over 100 people, 100 units, in hundreds. So if you've got 100 units in your complex, you can get a fairly accurate statistic. The average complex in South Africa being somewhere between 30 and 40 units each is what I always use as the norm figure. Your stats can be pretty accurate as well over a year, 3 years, or since the policy incepted. What does that mean to a trustee? Very simple. If a trustee, for example, receives your claims ratio, and you see that your claims ratio is running at 100%, that is not good at all, because it means that 100% of the premium was paid out in claims, and the insurance companies are running at a severe loss. And that means the insurance company will have to do some premium increases, or they will have to increase the excess on the policy to straighten it out so that they do not continue running at a loss. It is interesting to note that a policy, for every 100 Rand that an insurance company receives, only 60 Rand of that premium, roughly, is available for claims paying. 40% of your premium goes towards costs. How so? Well, the insurance company needs to pay their bills, they need to pay their staff, their rent, their advertising, their IT, and all of their expenses to run that policy. They also need to pay the broker, they need to pay their shareholders something, and of course, they need to pay the underwriting manager. So you've got a good only 60% of the premium. That means that your insurance company are starting to run at a loss at 60% claims ratio. So if your policy over a year or 2 years or 3 years or longer is continuously running at 60% and above claims ratio, the insurance company are paying you more than they should be for your policy premium. What is the correct premium? In other words, what would a fair premium be claim ratio wise? In sectional title, you need to see that your policy is running consistently, or more or less consistently, unless you have a large unexpected event like a flood, a huge flood, or a huge fire. But the claims on the normal day-to-day routine claims should actually work out at somewhere between a claims ratio of between 35% and 55%. In other words, if your claims ratio is in the 40s%, then you're probably in the right space. Your policy is running correctly. If it's running below 40% or below 35% in particular consistently, you're paying a higher premium than you should probably be paying, and there's room for a discounted premium. If your policy is running consistently at 55% and above, then the insurance company are going to want to remedy that. Okay, so anything between a claims ratio of between 0 and 35% consistently would mean that your premium is too high, in my view, as a broker, and I would certainly be looking for a discount for you. If you were running between 35%, which was probably ideal, 35 to 40%, to build a little bit of fat into your policy, but between 35% and 55%, if you like at 53%, 54%, it's still okay. If your policy is running above 55%, you're in danger zone, and the insurance company, on renewal at least, will need to do something to remedy. So, what does this all mean? It means that you can manage your policy, and you and your broker can look at things annually or half annually, but I say annually is really a good time. It's when your policy renews. It's a good time to really look at it. You'll probably receive a policy renewal invitation from your insurance company a few weeks before, and which your broker should actually be analyzing for you. You look at it and you think, gee, as a trustee, this is bad. They want to increase my premium by 20%. We're increasing our sum insured by 10%, but our premium is going up by 20%. Oh dear. We'd better go and find a new broker or a new insurance company. Not necessarily so. You need to have a look at why they've increased it. And if it's for no good reason, of course, then you query it and you do your testing properly. However, you'll probably find that the insurance company have looked at the claims ratio, which might be, say, at 60% or 70%, and say, oh, we need to actually build in a little bit more here. So what they may do is increase the premium a little bit to retrospectively bring your premium in line with the anticipated claims, so that your claims ratio runs below 55%. Okay, so think of it this way, mathematically. If your premium is running at 100%, in order to bring it back to 50%, effectively the insurance company need to double your premium. I really see them doing that harsher premium increase. They would normally incrementally increase it by maybe 20 or 30%, and then hope that the policy eases over. There could be reasons for the higher claims ratio. For example, you may be going through a period when most of your geysers are being replaced because of the cycle of time. You know, it's 5 years since every 5 years you might have a peak in geyser claims. You know, you might have had you might have just been, which is very typically at the moment, through a stormy season. But there may be reasons like your roof might be in need of repair or even replacement. Or you may need to manage your geysers properly. You might need to look at more sustainable geyser options, which we certainly do. We always look at things and say, you know, very often it's the roof coverage, the waterproofing, and the geysers are areas where you can actually mitigate a lot of the losses. Okay, so claims ratio, you can manage them. And, you know, don't be startled when you have a high premium increase. It's usually related to claims ratio. And on a last point, if your policy is running consistently at, say, 60%, call it break-even point, and somebody comes along and offers you a 10 or 20% discount to buy your business, in other words, we'll offer you a good premium, better than you're paying at the moment, beware, because that is usually a dangerous way to work. There are some very, I call them rogues out there, who try to just bring the business on book and then hope for the best. It's greedy, And it's reckless, because that could put your whole scheme at risk. Your claims ratio actually jumps automatically to 80%, and they're trying to take a gamble to see whether it pans down out to a lower claims ratio. But if it stays there or increases, you could well find that the body corporate finds itself with a policy cancellation in the not too distant future, which is disastrous, because then it can be difficult to get cover. So be careful with claims ratio. It's good to understand it, and keep your policy sustainable, i.e. between 35% and 55% claims ratio, if at all possible, and if it's within your capabilities to mitigate. Thank you. I hope that was helpful.